Hello, my name is Luana Okino Sawada. I will be walking you through on the research report of my expert advisor, Martingale VI Hybrid. Before beginning, I would like to introduce my mentor and product owner, Professor Masoud Sadjadi. Martingale VI Hybrid. Let's talk about the Martingale. What is the Martingale strategy? The Martingale strategy is compared with gambling because it's based on probability theory, meaning that if you have enough money, it has near 100% success rate. In order to achieve 100 probability with the strategy, you need a significant amount of money supply. Because this strategy depends on the theory of mean reversion. We'll see how it is. The Martingale strategy was introduced by Paul Pierre Levy as a type of betting style based on doubling down the bet. Suppose we have a betting coin game that we will bet in either heads or tails, and there is an equal probability, 50-50, that the coin will land on heads or tails. Since each flip is independent, the previous flip does not impact on the outcome for the next flip. If we start betting with $1 and we keep winning, we'll keep betting $1. But if we lose the current bet, we'll double our next bet in order to recover our previous loss and bring our net profit to zero. And if we win, we'll keep betting $2. If we lose, we'll double it again, and so on. This strategy can recover all the money from our previous losses if we win, but if we hit a losing streak, we will be down to zero, and even if we win, we are still far from our initial starting capital. How Martingale works applying in trading. Now that we understand the mechanics of Martingale strategy, let's understand how it works on the basic trading system. In the real world of trading, there is no binary outcome. The strategy is the same. The only difference is that a trade can close with a certain amount of profit or loss. We need to define a mixed movement of underlying price as a take profit and stop loss levels. Let's check the example. An example of how it works. Setting take profit and stop loss at 20 pips. Okay, we have the stable, that is the averaging down trade entry levels in failing market. Suppose I start with a buy to open order of one lot at 1.35. The rate then moves against me to 1.3480, giving a loss of 20 pips. It reached my virtual stop loss. It's a virtual stop loss because in real trading, there would be no point in closing the position and opening a new one for twice the size. I keep my existing one open on each leg and add a new trade order to double the size. So at 1.3480, I double my trade size by adding one more lot. This gives me an average entry rate of 1.3490. My loss is the same, but now I only need a retracement of 10 pips to break even rather than 20 pips as before. The act of average down means you double your trade size, but you also reduce the relative amount required to recoup the losses. This is shown by the break-even column in Table 1. The break-even approaches a constant value as you average down with more trades. In the figure below, we can see that we have 6 trades, where the first 5 trades we're just losing money, and then on the 5th to the 6th, it recovers all the money in one step. So at trader number 5, my average entry rate is now 1.3439, When the rate then moves upwards to 1.3439, it reaches my break even. I can close the system of trades once the rate is at or above that break even level. My first 4 trades closes at a loss, but this is covered exactly by the profit on the last trade in the sequence. The final profit loss of the closing trades looks like this. So the table 2 shows us the losses from the previous trades are offset by the final winning trade. As we can see, we lost the first 4 buys, we lost money, but then we end up recovering all the money that we lost. So we earn 15 and then we go back to a profit and loss 0. Martingale strategy in Forex. One of the reasons why Martingale strategy is popular in Forex is because currency rarely fall to 0 since countries cannot go bankrupt. That would be a global catastrophe, unlike stocks and companies. Another reason would be the ability to earn interest, what allows traders to offset a portion of their losses with their interest income, meaning that they would buy a currency with a high interest rate, high cost of borrow money, and earn that interest while at the same time selling a currency with a low interest rate. With a large number of lots, interest income can be very substantial and could work to reduce your average entry price. Martingale problem. The issue is that apparently dependable trades may blow up your account before you can turn a profit or even recoup your losses. Because of that, most of the traders feel that the martingale trading strategy offers more risk than reward. Let's talk about moving average. What is a simple moving average? Simple moving average is the addition of the closing price of the security for a number of times period and then dividing this total by the number of times period we analyzed, which gives the average price of the security over the time period. The simple moving average makes it easier to view the price trend of a security smoothing out volatility. If the simple moving average points up, this means that the security price is increasing, meaning uptrend. If it is pointing down, it means that the security price is decreasing, downtrend. A short-term moving average is more volatile, but its reading is closer to the source data. On the other hand, the longer the data frame for the moving average, the smoother the simple moving average will be. How simple moving average can help us? The moving average are used to help us determine the trend we have. To identify an uptrend, the fast moving average should be above the slower moving average, and for a downtrend, it should be the opposite. Example, the figure below, where we have a daily chart of US dollars to Japan yen with 2 moving averages, 10 simple moving average and 20 simple moving average. And in this case, we can see that is an uptrend since the fasting moving average, there will be 10 simple moving average, is above the slow one, 20 simple moving average. To conclude, let's talk about Martingale VI Hybrid. So basically, what is happening in Martingale VI Hybrid is that the strategy make a comparison with 2 moving average, 1 simple moving average, and 50 simple moving average to determine if it's an uptrend and should make a sell order, or if it's a downtrend and should make a buy order. Or checks if it's order open and then apply the martingale strategy. So on the tick function is where it's essentially the trades, where we're gonna have an if that will check the function trade. If the function trade returns 2, that means that we have a downtrend, so we should make a buy order. Or it checks if there is any buy order open and then apply the Martingale buy strategy. Or if the trade returns 1, that means that it's a uptrend, so we should make a sell. Or checks if there is order open for selling and then apply the Martingale sell strategy. After the algorithm being done, we'll have the results. Where in the results we can see a similar table that was presented before in the beginning, where we're discussing about Martingale. So we'll see the type that can be a sell, a take profit, or a modify, or a buy. And then we have the profit and imbalance on the right side. That's it. I hope you liked the video. Please feel free to email me to send feedbacks, or if you have any questions about this video, at lokino01@fiu.edu, or if you have any questions about the project, you can contact my mentor and project owner at sadjadi@cs.fiu.edu. Thank you for watching this video.